Hi, everybody. My name is Sam Chaplin. I'm the Associate Portfolio Manager here at Penobscot Financial Advisors. And one of the fun things I get to do as part of my job is to identify trends in the market and create charts to display those trends. And we thought it might be a good idea to create a quick couple-minute video every now and then to show you some of the themes we're looking at and we'll be monitoring going forward. The chart I'm going to show you here, I think, is pretty telling. Not only shows one of the outperformances in the market so far this year, but as well as one of the drivers behind that outperformance, where first we can look at the gray line, which is the S&P 500 value stocks performance year to date versus the S&P 500 growth stocks performance year to date in the blue line. And you can see value outperforming quite a bit so far this year. If you're not familiar with growth and value, I would first explain growth being a little more intuitive, where growth companies are growing. You might think they're going to outperform the market because they're growing at a faster pace than the other companies of their peers. We're on the value side, often more mature companies where maybe they don't have as much growth potential, but they could outperform their peers based on them being currently undervalued relative to what their intrinsic value should be. So often people, can look at tech stocks as a representative of growth stocks generally because they're growing, always expanding, launching new products, breaking into new industries, whereas things like traditional finance and energy are often on the value side since they're pretty mature, not necessarily as much growth opportunity, but often can still be great investments. And what you'll see is that the value stocks outperforming up 17.3% year to date versus the growth stocks up 6.3% year to date. And that's pretty counter to the trend that's been going on really since the financial crisis, where growth stocks, particularly tech stocks, have been outperforming in a big way. But one of the drivers we can see on this chart behind the outperformance this year is the move in treasury rates and generally in interest rates. So that green line is the treasury rate move year to date, where you can see it starting off around 1%, and now the 10-year yield is up to about 1.6%. Pretty big move on a relative basis there. And while you can see value stocks have been pretty unaffected by that move, the growth stocks have been hit pretty hard. One of the reasons being is that in being a growth stock, you're always looking for room for expansion, and you got to fund that expansion somehow. And debt is one of the two ways that you can fund that expansion. So growth stocks often carry high debt loads, high financial leverage, and that means their cost of capital is going up when the treasury rate and interest rates are going up. So the cost of borrowing is higher. That means some of the projects they might have been thinking about doing are no longer profitable, and generally just puts a dent in their growth rate over time. So we've seen that trend playing out so far this year. It'd be interesting to see if value continues to outperform or if growth does stage a comeback here. And obviously that depends a lot on what the move is in treasury rates. So that'll be one theme we're watching going forward. Thanks.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.